You know what nobody's talking about right now? The fact that we're about to enter the most powerful seasonal window for gold in the entire calendar year. And I'm not talking about some vague tendency or weak correlation. I'm talking about a pattern so consistent, so historically reliable, that institutional traders have been positioning for it since October. Let me show you exactly what's coming, and why the next 90 days could be absolutely critical for anyone holding dollars. Here's what caught my attention last week. I was reviewing positioning data from the CFTC, and I noticed something fascinating. Large speculators, the smart money, they've been quietly accumulating gold futures since early October. Not making headlines, not causing price spikes, just methodically building positions. And when I dug into the historical data, I understood exactly why. Because what's about to happen in gold over the next 3 months happens almost every single year. And most retail investors have no idea it's coming. Let me take you back to understand this pattern. If you look at gold's performance over the last 40 years, broken down month by month, something remarkable emerges. From late November through February, gold has posted positive returns in roughly 75% of all years. That's not a coin flip. That's not random market noise. That's a structural pattern, driven by forces that repeat year after year after year. And right now, we're standing at the beginning of that window. But here's what makes this year different. This year, we're not just dealing with normal seasonal demand. We're dealing with a convergence of factors that could make this seasonal rally unlike anything we've seen in over a decade. Think about what's happening right now in the global economy. Central banks just posted their highest quarterly gold purchases in history. Not last year, not 5 years ago, last quarter. The People's Bank of China alone added 42 tons in September. Turkey added 29 tons. India added 17 tons. These aren't small players making symbolic gestures. These are major central banks fundamentally restructuring their reserve positions. And they're doing it right before the seasonal window opens. Let me explain why that matters. Seasonal patterns in gold aren't random. They're driven by predictable demand cycles. Chinese New Year, which falls in late January this year, drives massive physical gold demand across Asia. Indian wedding season, which peaks in December and January, creates sustained jewelry demand. Western investment flows, which historically increase in January as new capital enters the market. These aren't theories. These are documented, measurable demand surges that happen every single year. But this year, we're not starting from a position of oversupply. We're starting from a position where the physical market is already tight. I was talking to a dealer in Singapore last week, and he told me something that should concern anyone paying attention. Premium for physical gold bars in Asia are running 2 to 3% above spot price. That's not normal. In a healthy market, those premiums should be 50 to 75 basis points. When you see premiums at 2 to 3%, that's telling you something about the underlying supply situation. That's telling you the physical market is already stretched before seasonal demand even kicks in. Now let me show you what happened the last time we had this set up. Go back to late 2010. Gold was trading around $1,300. Central banks had just started becoming net buyers after 2 decades of selling. The physical market was tight, and we were entering the seasonal window. What happened next? Gold rallied from $1,300 in November to $1,430 by December, then pushed all the way to $1,900 by August 2011. Now, I'm not predicting we see that kind of move this time, but I am saying the setup rhymes, and the forces driving that rally, they're present again today. Here's what most people miss about seasonal patterns. They're not about the calendar. They're about the underlying forces that the calendar represents. When we talk about gold's seasonal strength from November through February, we're really talking about a period when physical demand surges, investment flows increase, and supply remains relatively static. The calendar is just the marker. The real story is what's happening beneath the surface. And beneath the surface right now, something remarkable is building. Look at what's happening in the futures market. Open interest in gold futures just hit a 6-month high. That means more contracts, more leverage, more potential energy in the system. And here's the key detail. The commercial traders, the producers and refiners who actually handle physical gold, they're net short at levels we haven't seen since early 2020. You know what happened after early 2020? Gold rallied from $1,600 to over $2,000 in 6 months. Why does commercial positioning matter? Because these aren't speculators guessing about price direction. These are companies that need to hedge their physical exposure. When they're heavily short, it means they're expecting to produce or handle more physical gold than usual. And they're locking in prices now because they believe current levels are attractive. That's not a bearish signal. That's a signal that the people closest to the physical market see value here. But let's talk about what could disrupt this pattern, because no seasonal tendency is guaranteed. The main risk to gold's seasonal rally would be a dramatic strengthening of the dollar or a sharp rise in real interest rates. And right now, neither of those scenarios looks likely. The dollar index is sitting near yearly lows. Real interest rates, after accounting for inflation, are barely positive. And the Fed just signaled they're done hiking rates. That's not an environment where gold typically struggles. In fact, let me show you something about Fed policy and gold's seasonal pattern. When the Fed is in a holding pattern, neither hiking nor cutting aggressively, gold's seasonal tendency actually strengthens. Why? Because uncertainty about future policy creates demand for safe haven assets, and gold is the ultimate safe haven. No counterparty risk, no default risk, no political risk, just pure monetary insurance. And right now, uncertainty is everywhere. Will the Fed cut rates in 2024? Will inflation resurge? Will the economy slip into recession? Nobody knows. And when nobody knows, gold becomes more attractive, especially during its strongest seasonal window. Now, here's something I want to address because it's relevant to a lot of people watching this. If you're sitting on retirement accounts, IRAs, 401ks, and you're concerned about dollar devaluation or inflation eroding your purchasing power, there's a way to get physical gold exposure inside those accounts without triggering taxes or penalties. I put together a free guide that walks through exactly how gold IRAs work, what the rules are, and how to evaluate if it makes sense for your situation. It's in the description below. No obligation, just information. Worth looking at if you've got 100,000 or more in retirement accounts and you want to understand your options. All right, back to the seasonal pattern. Let me show you the month-by-month breakdown because the details matter. November historically shows an average gain of about 1.8%. Not massive, but consistent. December averages 2.3%. January, this is where it gets interesting. January averages 3.1%. And February typically adds another 1.5%. Add those up, and you're looking at a historical average gain of nearly 9% from late November through February. 9% might not sound like much in a world of meme stocks and crypto volatility, but here's what makes it powerful. Gold is a $5 trillion market. A 9% move in gold represents $450 billion in value creation. And unlike speculative assets, gold's moves tend to be more stable, more predictable, and more driven by fundamental forces than sentiment swings. But here's where it gets really interesting. Those are the averages. In years when gold enters the seasonal window with strong momentum, the gains are typically much larger. In 2010, gold gained 14% during the seasonal window. In 2016, it gained 11%. In 2019, it gained 8%. And in each of those years, the setup was similar to what we're seeing now. Tight physical markets, central bank buying, uncertainty about monetary policy, and gold entering the window with positive momentum. Right now, gold is up about 8% year to date. That's positive momentum. Not explosive, but steady and sustainable. And that's actually the ideal setup for a seasonal rally. When gold enters the window up 30 or 40%, it's often overbought and due for consolidation. But when it enters up single digits, there's room to run. Let me show you what's happening in the mining sector because it's telling us something important. Gold mining stocks, as measured by the GDX ETF, are up about 12% year to date. That's outpacing gold itself. And historically, when miners outperform gold heading into the seasonal window, it's a bullish signal. Why? Because miners are leveraged plays on gold prices. When they're outperforming, it means investors are positioning for higher gold prices ahead. And the fundamentals in the mining sector support that positioning. All in, sustaining costs for major gold miners are now averaging around $1,200 per ounce. With gold trading around $1,900, that's a $700 margin. That's healthy. That's sustainable. And that's why miners can afford to pay dividends, buy back stock, and still invest in exploration. When the mining sector is healthy, it typically supports higher gold prices because supply growth remains constrained. Now let's talk about what's happening in Asia, because this is crucial to understanding the seasonal pattern. China's gold imports through Hong Kong hit a 5-year high in September. 5-year high. And we're not even in the peak demand season yet. Chinese New Year is still 2 months away. Indian gold imports in October were up 43% year over year. 43%. And again, we haven't hit wedding season yet. What's driving this demand? Part of it is cultural. Gold is deeply embedded in Asian culture as a store of value and a symbol of prosperity. But part of it is economic. Asian consumers are watching their currencies weaken against the dollar. They're watching inflation erode purchasing power, and they're turning to gold as protection. That's not a temporary phenomenon. That's a structural shift in how Asian consumers view wealth preservation. And here's what makes it powerful. Asian physical demand is price insensitive. When Western investors buy gold, they're often trading, buying low, selling high, trying to time the market. When Asian consumers buy gold, they're accumulating. They're not looking to flip it next month. They're buying for weddings, for dowries, for generational wealth transfer. That creates sustained, structural demand that doesn't disappear when prices rise. Let me give you a specific example. In India, gold purchases for weddings are non-negotiable. If gold is trading at 1,800 or 2,000 or 2,200, Indian families are still buying for weddings. The price might affect the quantity slightly, but it doesn't eliminate the demand. And with over 10 million weddings happening in India during the peak season, that's a massive amount of physical gold flowing out of the market every single year. Now, combine that structural Asian demand with what's happening in the West. Western investment demand for gold, as measured by ETF flows, has been relatively muted this year. Gold ETFs have seen modest inflows, nothing dramatic. And that's actually bullish. Why? Because it means there's dry powder. When Western investors decide to rotate into gold, there's enormous capital sitting on the sidelines ready to flow in. And what would trigger that rotation? Uncertainty, fear, concern about the financial system. And right now, all three are building. Bank failures earlier this year reminded everyone that the financial system isn't as stable as it appears. Geopolitical tensions are escalating. The debt ceiling debate is coming back. These are the kinds of catalysts that drive Western investors into gold. But here's the key insight. You don't need a crisis for gold's seasonal pattern to work. The pattern works in normal years. It works in calm years. It works because the underlying demand drivers are predictable and recurring. The seasonal pattern is the baseline. A crisis would be the accelerant. Let me show you what happened in 2022 to illustrate this point. 2022 was a tough year for gold. The Fed was hiking rates aggressively. The dollar was surging. Real interest rates were rising. Gold ended the year basically flat. But even in that challenging environment, gold still rallied during its seasonal window. From late November 2021 through February 2022, gold gained about 6%. Then it gave those gains back as the Fed continued hiking. But the seasonal pattern still worked, even in a bearish macro environment. That's the power of seasonal patterns. They're not dependent on everything going right. They're driven by forces that persist, even when the macro backdrop is challenging. And this year, the macro backdrop isn't challenging for gold. It's supportive. Think about what the Fed is dealing with right now. Inflation is still above target. The economy is slowing but not collapsing. The labor market is cooling but not crashing. That's a Goldilocks scenario for gold. Not so hot that the Fed needs to hike aggressively. Not so cold that deflation becomes a concern. Just uncertain enough that safe haven demand persists. And uncertainty is gold's best friend. When investors are confident about the future, they don't need gold. They can take risk in stocks, in real estate, in credit. But when the future is murky, when the path forward is unclear, gold becomes essential. And right now, the future is very murky. Will China's economy stabilize or deteriorate further? Will the Middle East conflict escalate or resolve? Will the U.S. government avoid a shutdown? Will commercial real estate defaults trigger a broader financial crisis? These aren't hypothetical concerns. These are real risks that investors are grappling with right now. And each one of them supports higher gold prices. But let's get specific about price targets, because that's what everyone wants to know. Where could gold go during this seasonal window? If we see a normal seasonal rally, gold could push toward $2,000 by February. That would represent about a 5% gain from current levels. Not spectacular, but solid and consistent with historical patterns. If we see an above-average seasonal rally, driven by a catalyst like escalating geopolitical tensions or a surprise Fed policy shift, gold could test $2,100. That would be about a 10% gain, still within the range of historical seasonal moves. And if we see a perfect storm, where seasonal demand coincides with a major risk event, gold could push toward $2,200 or higher. That would be a 15% plus gain. Unlikely, but not impossible given the current setup. The key is understanding that the seasonal pattern provides a baseline expectation. The actual outcome will depend on how other factors develop. But the baseline is bullish. The historical tendency is bullish, and the current setup supports that bullish bias. Now, let me address the bear case because it's important to consider both sides. The main argument against gold right now is that real interest rates could rise if inflation falls faster than expected. If inflation drops to 2%, while nominal rates stay at 5%, real rates would be 3%. That's a challenging environment for gold. But here's why I'm not worried about that scenario. First, inflation isn't falling that fast. Core inflation is still running above 3%. Services inflation is sticky. Wage growth is still elevated. The path from 3% inflation to 2% inflation is much harder than the path from 9% to 3%. Second, even if inflation does fall faster than expected, the Fed would likely cut nominal rates in response. They're not going to maintain 5% rates if inflation is at 2%. That would be unnecessarily restrictive. So the scenario where real rates surge high enough to derail gold's seasonal rally requires both falling inflation and the Fed keeping rates elevated despite that falling inflation. That's not impossible, but it's not the most likely path. The more likely path is that inflation remains sticky, the Fed stays on hold, real rates stay low, and gold's seasonal pattern plays out as it typically does. That's not a bold prediction. That's just following the historical playbook. And here's what gives me confidence in that playbook. The forces driving gold's seasonal pattern haven't changed. Asian demand still surges during this period. Western investment flows still increase in January. Supply still remains relatively static. These are structural factors that persist year after year. And this year, they're being reinforced by central bank buying, geopolitical uncertainty, and concerns about currency debasement. Let me give you one more historical parallel because it's instructive. In late 2015, gold was trading around $10.50. It had been in a bear market for 4 years. Sentiment was terrible. Nobody wanted to own gold. But as we entered the seasonal window, something shifted. Physical demand picked up. Investment flows turned positive. And by February 2016, gold had rallied to $1,200. A 15% gain in 3 months. What drove that rally? Nothing dramatic. No crisis. No Fed policy shock. Just the normal seasonal forces reasserting themselves after years of being overwhelmed by bearish macro factors. And once those seasonal forces took hold, gold's momentum shifted. I'm not saying we're in an identical situation today. Gold isn't in a 4-year bear market. Sentiment isn't terrible. But the principle is the same. Seasonal patterns are powerful. They can overcome negative sentiment. They can drive meaningful price moves. And they're most powerful when they align with supportive fundamentals. Right now, the fundamentals are supportive. Central banks are buying. Physical markets are tight. Real rates are low. The dollar is weak. Geopolitical risks are elevated. And we're about to enter the strongest seasonal window of the year. That's not a guarantee of higher prices, but it's a very favorable setup. So, what should you do with this information? That depends on your situation, your risk tolerance, and your investment goals. But here's what I'm watching. I'm watching physical premiums in Asia. If those premiums continue expanding, it's a sign the physical market is getting tighter. I'm watching ETF flows. If Western investors start rotating into gold, it could accelerate the seasonal rally. I'm watching the dollar. If the dollar breaks below its recent lows, it could provide additional fuel for gold. And I'm watching the calendar. Because the seasonal window is opening right now. and history says the next 90 days could be very interesting for gold. Not guaranteed, not certain, but historically powerful. And in a world of uncertainty, sometimes the most reliable guide is what's worked consistently in the past. Gold's seasonal pattern has worked for 40 years, and all the evidence suggests it's about to work again.